I'd love to spend lots of time just catching up with all of y'all. It's been a while since I've been able to like really talk with you or text. Maybe we've sent one text back or forth um, since my baby boy's been here. But
Yeah, let's
Congratulations.
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 Wow.
I appreciate it. I appreciate it. I've been having babies so long. I'm into my 40s, which is very appropriate for, the discussion that we're going to have today
It
about
is.
what infinite banking looks like after 40. And I did strategically record a before 40 infinite banking episode. And I do think that, there are just some times in life where it's at an actual age or whether it's a life event or whatever the case may be, where some things change. Even biblically, this idea of seasons, there are seasons in life. So something around 40 seems to be a big deal in our culture. So I made sure to record a video a while back about, well, infinite banking, because that's different, right? I mean, when you've got your first job or two, and maybe you're not even married yet, or maybe you are, and you got that first baby, that's very different, perhaps, than people that are focused on other things. And I don't want to talk too much about that because I want y'all to with me. But yeah, I did think that that was interesting that Lauren and I have had our fourth baby. We are 40 as of this year, so we're right at that beginning of that next season, and we're implementing infinite banking at the level that we are too, though, well, we've been doing it for a decade as well. So we've got a lot of great experience here in the room in general, and then a lot of great experience when it comes to infinite banking and different perspectives. So let's do this. Nobody's new here this morning. If anybody watching is seeing these guys for the first time, each one of these fellas has a one-on-one introductory interview with me on our interview series. You should check that out. Great people, great conversations. But today, this isn't even any of our first times at a round table. So here's the discussion. Infinite banking after 40. If y'all let me, let's jump right into it. I got one childhood memory where a family member turned 40, and that was the first time I believe I'd ever even heard that saying of over the hill. So tell me if I'm, reading the culture right. Is turning 40 still a pretty big deal? Is that impactful?
I would say for like the outside perspective, like, and I say outside meaning maybe outside my own head and outside my family. I think a lot of people do tend to think about 40 as a big deal, but I think for a lot of people, because people are living longer, they tend to think about 50 as maybe what that 40 used to be for a lot of people. Um, but I didn't, I was like, what's the big deal? Like, it's 40, right? And I think at some level, society kind of creeps in and it's like, 40 is kind of a milestone. It's a big deal. But I, I don't know. I've achieved more since I've been 40 than maybe what I did um, prior to that. And I think a lot of it comes with your mindset starts to change on thinking differently as you hit that age profile. But it's not because you are older per se. It's because you have this 20 some years of adult experience to fall back on, and you actually start to listen to people who are older than you because you realize those mentors actually are communicating that advice for a reason. It's not because they're, well, I know more than you do, so I'm going to tell you about it. It's they actually want to help you. And I think learning that way, you're like, okay, now I understand where all this is coming from. I can put it to use and benefit myself, benefit those around me for sure, and go from there.
That's something I've noticed. I'm 43 myself. On turning 40, like the 20s and 30-year-olds, I did notice a shift where they start listening and paying attention a bit more. I mean, nothing's really changed. I didn't feel anything changed in me, but they're like, "Oh, this guy's 40. He's a little wiser now suddenly." But then realizing that the responsibility kind of weighs a little bit more, that I need to be more careful in how the advice I'm giving, and more intentional, more deliberate.
I know
And
what you're saying right there, Will, when you talk about maybe a renewed sense of responsibility, when you see
Yeah.
somebody's face looking at yours to see what you're doing or what you're saying or what you're thinking. I have felt that before, and that's interesting because internally I'm like, am I that guy? I'm like, there's a part of me that's like, I know I've acquired skills and I know I've acquired experiences and I think they're very valuable. But then there's another part of me that's like, surely not me. Not yet. I'm not there yet. So I think that's interesting.
so if I weigh in on this, because I turned 60 last year, actually this past year, and the weight of 40 and then the weight of 60, uh, I told what you guys are talking about definitely resonates with me from a standpoint that like my older daughter, who's gonna turn 30, like I feel the weight of her looking to me for advice more than ever. And I sometimes when your kids are younger, you kind of, I personally, in retrospect, take it for granted that our actions and our messaging weighs very, very heavily on them, even at a very young age, but then it becomes even more poignant and even more and even heavier and weightier, not in a bad way, just in a responsibility way as our kids get older. So this discussion that we're having today about IBC after 40, um, I feel like Jesse, you could actually do a bunch of series after 40, after 50, after 60, because each, like you talked about the seasons, maybe every decade, there's a different feeling behind what we do as practitioners and also us as family people and what weighs on us. Legacy maybe starts to creep even more so as we start to see we're on the backside of the 18 hole match. So we're like in the fifth inning and we're in the top of the sixth, so to speak. So that's what's on my heart right now in this discussion.
I love it. So knowing all of y'all are fit people. I'm making another mental connection of another reason why I like y'all. I mean, Will built like a tank, Rob, all the miles that he puts in, David swimming better than the fish. Um, I feel like I saw on y'all's faces even something that I felt on the inside when we start talking about, because there are all these things. There are these family things, there are these work things and our colleague things, but then there's even, physical fitness and oh no, we can always take things to a new level. That's my mentality. It's like, no, I want to get better every day. Um, so anyway, part of my thinking is, I like just that we haven't even really talked about infinite banking just yet. I know we're going to, but we're talking about the impact within our family, the impact within our workplace, the impact within a camaraderie that people can have where you're surrounding yourself with other people that are active physically and mentally and all these other aspects that are very, very important in life. I actually really like where we're at in the conversation. I've got a picture I want to paint to y'all and have y'all help me flesh it out, check my thinking on it, anything that occurs to you. And then I want to present a myth that I believe is appropriate for this season in life that we're talking about when it does come to infinite banking. So I would say it seems to me that in general, people that are, and let's talk in that category of maybe 40 to 50 for a moment. Traditionally speaking, statistically speaking, folks that are 40 and not 50 yet, so they're in their 40s, they're not, if they're in the workforce, not typically even in their peak income earning years yet, statistically. I think that's an interesting thing to keep in mind. They very well may be like me. They very well may still be having children, and some folks are even having children later in life anyway. Some still have them plenty early. I know we've got a mixture here. Lauren and I, we actually were married about 7 years before we had children. Intentionally, that's the way we want to do things. But anyway, folks are having children late. They're not in their peak income earning years yet. They might even be not in their last or final career. So I'm just trying to give some generalities right here so we can talk about this. So they're kind of in that mixture of maybe still climbing the ladder or getting on a new ladder. still having children, growing children, still not in those peak income earning years, but very, highly involved if they do have children, excuse me, or are married, etc. What else would y'all, I'm just trying to put a skeleton together right there. What else do y'all see of where people are, what's going on in their lives? And then we're going to make a connection here to when you are implementing infinite banking already, or you're considering infinite banking as your financial paradigm. What do you have going on in life? What are your questions? What looks different?
I think from what you were saying there, a lot of people, those who don't practice infinite banking, they get into 40 and 50. They're looking forward to that age 65, collecting that Social Security check, retiring, starting to draw down. They're already thinking about the drawdown, being in the fourth quarter of their life, uh, moving on to a 10 to 30 year vacation, um, and spending that. Where practicing IBC, we're thinking multi-generationally. We're still thinking about building to leave more. Not that we're going to be working 9 to 5 or anything like that till our 80s, but that we're still building. We're not drawing down all the way until we graduate.
I love that you brought up the topic of retirement. Good, Will. Thank you. I knew there was more that I was missing. I think that there are going to be plenty of people that if they're in a career, they've probably contributed to some qualified plans or something through work, etc. And they're probably in this age realizing that maybe they haven't been doing enough of whatever they have been doing because they are close enough to retirement here in the US. Um, I don't like the word, but I'm using it because it's common vernacular. I don't like the idea behind it. Y'all know that.
Feel the same
But
way.
I know. But traditionally speaking, folks are probably going to have more impetus behind what it is that they are doing with their money because they are closer to retirement and maybe they do see the light at the end of their tunnel according to their thinking right now. That's a huge point I think that we ought to get to. Anything else?
I personally would say that because of the proliferation of information 24/7, I think the 40-year-old today has a lot more information in their system than the 40-year-old, let's say 20 years ago. Meaning, I think the 40-year-old already knows that saving for retirement in the traditional sense is a broken system. And even a lot of what's been, even the gentleman I believe that introduced the idea of the 401k has come out recently to say that in retrospect that he's debunked the fact that that's actually a very meaning way to be able to save money for retirement. So I think that the average 40-year-old is better equipped to understand that there's other ways that they need to think outside of their normal thinking, which ties into what we do as practitioners. Um, so that's my feeling about, you know, what IBC looks like for a 40-year-old or someone in their 40s.
Yeah, I think the arrival syndrome, the danger of the arrival syndrome is the counterbalance to what you're saying. Here's what's possible. There's so much information, and a lot of it's good, but a lot of it's bad out there. I think that as well, people are probably more open-minded to unconventional approaches to finance and other important categories of life. But still, I mean, we all know that that arrival syndrome goes along with being 40 and older because we do have a lot of experience. We do have many years of programming, propaganda, influence, so that it doesn't negate that as well. Like I think those two things are coupled together, I think.
And I also do think that, I remember myself in my 40s, I had a lot of unbridled overconfidence about how things should be done because I'm in my peak. I'm starting to become into my peak years where like I know what I'm doing and just stay out of my way. Like almost like with the arrival syndrome. Like, so I think I think that's something that sometimes I personally see, I come across thinking about myself in my 40s and maybe viewing people in their 40s. So like the idea of the arrival syndrome definitely is very, very much at play here.
Yeah. And I wouldn't negate though, David, that experience, like that knowledge, that certainty that you have of, oh no, I'm very good at what I do now. That's true. But what I would remind people is that just because you're very good in one thing doesn't mean that you're not brand new in something else, right? And if you've not been doing infinite banking, so if we're talking to the person that's vetting this concept, they are that open-minded person, they are watching this video and tune into us and hearing our thoughts and going to glean from our experiences. Just because you have the expertise over here in your work, in your family, and you're still brand new. So just friendly advice. Remember the arrival syndrome can get any of us at any point in time. So remember that.
Yeah, I will say that I think a lot of people, I can't remember which one of you mentioned it before. I think a lot of people do actually realize that there's probably something not quite right with their system. And I think a lot of people start to get to realize that as they get into that age 40 range because they've been doing kind of following the steps that they were told. And you get there, and I'm speaking more so for myself personally because this is what I went through, and I would consider myself a lot more educated in the financial spaces than probably the average person was because I had a lot of people asking me for advice going through that time, even though I didn't carry any licenses or anything like that, financially speaking. But going through up until my 40s, and then I realized something's not quite right. I it I think a lot of people come to that realization around that time frame. And when I look at some of the data from the Federal Reserve and some of the data that's out there, I'd actually just been doing some of this recently. The average person from age 45 to 54, the median amount of retirement funds that that person has is $115,000. That's the median. So the average is like 313, but we know that that's skewed upward because of the amount of people that are maybe on the those that high end of the scale, which is well above or well outside that bell curve, if you want to say it. But to have your median at 45 to 54 at only 115,000, I mean, you can add a lot of rates of return and other stuff like that onto there and assume you're going to get there. But we all know that at least those of us who really understand that doesn't always work the way that the calculator says. And if we don't do something about it and start to think differently about that process, we're going to find ourselves in a challenging spot. And that's where I was at. So I found infinite banking when I was up into my 40s. I think I was probably William's age when 43-ish when I found it. So, and once I found it though, I was like, this is part of what I was missing. And so I would just say that for anybody who is maybe younger than 40 that's watching this, you tend to have a lot of bravado thinking that you're doing what you're supposed to or you're following all the right wisdom. But the statistics show that conventional, or I shouldn't want to say conventional, but that typical wisdom doesn't bode well for us. And the statistics show it. Um, Say all you want about the federal government. One thing they are really good about is collecting data, and they're very good at data entry. And the data is showing pretty significantly that people are not doing enough to put themselves in a position to carry on that legacy, to build the legacy that they want to see. And that's something that I realized, hey, I'm not in a position to build the legacy I want to have for my family. And it's not all about financial, right? It was multiple things like spiritually, lots of different avenues. And so I think getting to that age, and, kind of tying it into some of this, I think it is a little bit of an eye opener in some respects of what do I need to do next? How, what do I want to put in over these next 40 years if I'm gifted them to really make it count? And that's where I think I really thought about it differently when I kind of came into this age range of, okay, what do I want to really do to make this work?
the one thing that occurs to me very strongly from that number that you threw out there, Rob, is that
Mhm.
let's say the person that's hearing this and they're in their 40s or 50s and they've got something like those six figures
Mhm.
somewhere today.
Yep.
I would suggest that any potential rate of return is not guaranteed to fix that problem.
Correct. It is not.
It's not guaranteed to address that problem. Like no rate of return, here's a great chance for us to just tap into the spine of infinite banking. There's no rate of return that's guaranteed to fix that problem of providing legacy, passive income to supplement later in life, access to capital now because you're still actively doing lots and lots of things in your 40s and 50s, family and educations and so much. I'll share some stories with y'all about conversations I've had just in the past 2 or 3 days. You're still paying for so much, but there's no rate of return that can fix that. But if you could readdress how you manage your cash flow and start recapturing the majority of your recurring cash flow, if you could start to retain that, because that is something that you control. Like we get to decide where we put our income. When we earn an income, however we earn that, we get to decide where that goes from there, right? And that 5% or 12% or 20% or 17% or 6% or whatever kind of rate of return we could hope for. And I say hope, and I say guarantee when I say these words, I'm saying them on purpose. Addressing our cash flow through the infinite banking concept is the way to address that with some guarantees. That's what I'm saying. All right, so it seems to me that the majority of Americans in this age range are paying for a whole lot of things: the cars, the homes, the boats, maybe the second homes, college educations, perhaps for their oldest kids. If it's not college educations for the oldest kids, it's all the sports and everything for their younger kids. They might even have parents that are entering into long-term care stages of life, or you're doing things. So, like, there's a big list. The more I think about that, you're right, you might be caring for parents or maybe grandparents if you're still fortunate enough to have your own grandparents in this age category. Some people do. I love that. But you're probably helping even care for those people. That's more of a drain on your time and your finances. You're not protected enough. The vast majority of Americans do not either have life insurance, don't have enough life insurance, or they have something and it's through work and they probably don't even know what it is. And if they leave work, they won't get to keep it. So, you know, I think that's, and then they don't have enough in retirement. Going back to, what Will was bringing up about retirement, they're realizing that they also don't have enough anywhere to plan with some certainty for what those next decades in life are looking like. Is that fair? Y'all check me on any of those statements that I'm trying to paint the picture of the average American right now, or anything that you'd like to add into that?
I mean, I'd say it's very fair. Um, when I think about the what you had said, and I think about coupling that with typical financial advice, a lot of what we see is to put a lot of velocity, or the attempt to put a lot of velocity on a little bit of our income. And it's 5% or 10%. And it is a major shift in our mindset to say, what if I just put velocity behind the vast majority of my income? It doesn't have to be a lot, meaning I don't have to have a massive rate of return, so to speak. But if I were to take 30%, 50% of my income, and now it's doing something for me, even though I still get to use it, that's a lot of what we're trying to do. That's a lot of what infinite banking is all about. It's taking, instead of it being this tiny portion, we have a significant portion that is doing something for us in the long run. And then the sweetener, so to speak, is there's also death benefit to carry on our next generations. But that's one of the thoughts that came to my mind as you were talking about that, Jesse.
Y'all help me with this. As we continue this conversation, I'm really wanting to speak to people who are vetting this concept, but I also want to make sure we're dropping some key points to those who have implemented the concept, but they're looking to take it to the next level because they are at a later stage in life. Okay, so help me with that. I want to keep that mentality as we move forward. I've had a lot of great conversations, even here in the past 2 or 3 days. One family that you're making me think of, Rob, I've had a client for more than a year. I've been on the phone with 2 out of the 3 sons she has right now. One son's already implemented the concept as well. So generation 1 has started, right? She's actually in underwriting right now for her second policy. Been a client for more than a year, rocking and rolling, ready to get another policy. Talking about policies on grandchildren. So we're excited, looking forward to the 3rd generation, getting covered, getting that protection sooner rather than later. I mean, our lives are our most important asset. That's my perspective. It's the first thing that we should insure before the homes, before the cars, before everything else. These sons, though, these 2 sons, because one of them's already implemented the concept, the other 2 are getting on board now. They're going into underwriting. They're in this age category that we're speaking to, right? They're with young children, some of them with college age children. These children are wanting to get their first cars, but their parents are right at the door of retirement. So they're talking about legacy, they're talking about passive income, they're talking about retirement. It's just a really neat age in life. What I've found is 2 numbers are some data points that I want to convey to anybody. It doesn't matter if they're in their 20s or 40s or 60s or beyond. It doesn't matter. I always want to let everybody know when it comes to that protection, Rob. Okay, here's where you're at today. Let's see what kind of insurance you have. How much of it do you have? Okay, when I'm having consultation calls with my clients, we're going to look at that. We're going to be aware of that. And I'll just tell them, look, based on your age, your income, your net worth, this is what the amount of insurance is available to you. Here's the number. And I'll tell them what that number is. Okay. And then I'll show them, well, you've either got nothing or you've got something in the workspace that you have. Maybe you've personally gone out and gotten something. Awesome. I love that. But here's what I almost always find is that I'm showing them that they've got 7% of what's available to them. I'm showing them that they've got 14% of what's available to them. Like it doesn't happen that I come across somebody who's looking to do better financially and they've got 100% or even more than half of what's available to them in insurance, in protection, in death benefit. I always just want to make people aware. Hey, did you know that you only have acquired 7% of what's available to you? And then how do you feel? Young man advancing in your career, not even in your peak income earning years, taking care of children. You've got minors in the house. You're married. How do you feel about having 7% in force of what's available to you? And then, they decide what they wanted to decide. Oh yeah, I need to get everything that's available to me. I need to get a lot more anyway. Let's do this, right? And I'm looking to point that number out to them, get them that data point so they can make a decision about what they want to do better moving forward. The other, and here's where infinite banking comes in, of course, is because we do, like you were explaining, Rob, we get to check a lot of boxes when we implement this concept. We get the protection, we get the access to capital, so many things. The other metric, though, the other data point that I want to get people, the individual, is, okay, out of what you earn, how much of that do you send to a commercial bank? The answer is always 100%, right? Whether you're working for yourself and earning cash money, where do you go put that cash money? You take it to the bank. You're working and W-2, direct deposit, it goes to the bank. Well, of course, recognize that a bank is a business. So you're currently directly depositing 100% of your cash flow into somebody else's business. If you're looking at infinite banking and you want to become your own banker, of course, that's how I got to show you all the book, is I got to hold it in front of my face so the camera will pick it up. Okay, now what metric? Here's the data point, okay? How much premium are you considering as appropriate for you to pay into whole life policies that have been properly designed for you to implement the infinite banking concept? And then what's that metric, right? Because you're putting 100% of your cash flow into commercial banks now. Okay. So when you tell me what you think is an appropriate amount of premium for you, what's that metric look like? If you got $100,000 income and you're looking at a $10,000 premium, simple math tells me, okay, we're looking at first step being 10%. So I'd love to hear y'all's thinking around that. I think those are two very helpful data points. How much are you protected? Put it to a number. How much are you going to either begin to become your own banker with, or again, because we're talking to folks that have already implemented the concept, that client that I was just speaking of who's ready to start a second policy. Okay, now what does that put your percentage of your current cash flow towards your private family banking system now? I think those are two helpful numbers. Do y'all have any thoughts there?
The conventional advice for planning, for financial planning, is usually something along the lines of 10% being set aside for the emergency savings. Um, and that's probably a pretty good place to start. Not everybody can start there, but that's probably a good target to what you're putting in a savings account already. Just change where you're storing it. You won't notice a thing, and um, you get death benefit for effectively free just by changing where you store your money. So that's the place I'd probably recommend people start thinking, if they're vetting it and they're not quite sure. But most people, in fact, I haven't heard anybody say, "Oh man, I started too big." It's always, "I started too small. I wish I'd started bigger." But the most important thing is to start. Um, you probably say it a bunch. I've heard it a bunch of times. When's the best time to plant a tree?
20
That's
years
another
ago.
great point that you brought up. So let me add then, Will, that facet to the picture of our average American. I would say that most people 40 and beyond still, when they start looking at their personal finances, probably realize that they don't have enough, maybe none, in savings, in an emergency fund. That's definitely something else that I talk about with folks regularly and point that out. Hey, how are you positioned? Because you are married, perhaps, because you are still not in your peak income earning years, and there could be a career change. I mean, we you know this, Will. We recently had furloughing happening, with folks working for the government and such, and people lose jobs. Businesses shut. So having enough in an emergency fund, I think, is very important.
I'll also, Jesse, I love the fact that you, as you're sitting down with fine folks, you show them how underinsured they really are, in a way where I like how you show that they have a certain percentage of death benefit that they could have instead. Because we, as in the insurance field, we always make typical calculations of human life value or income replacement. But I like the way that you show your prospects and your clients that, it's very important to know that there's dollars that, as we're talking about IBC, that you're committing to a system that's addressing multiple things at the same time. Very importantly, and again, maybe it's people in their 40s, that death benefit can be, it's an asset that you're building and that you are leveraging as you're doing IBC. But most people, I think, me included, when I was 40, and my wife will attest to this, she was worried I wasn't insured enough. And I don't know, I think that in your 40s, I think those are conversations that I believe, um, husbands and wives, as when it comes to family and they're building their family, that becomes much more poignant at that age. It certainly did for me. So
Yeah, I fully agree with you on that statement, David. Excuse me. My That was one of the things when we first got into doing this as a family, I'd asked my wife, like, what's one of the things that you feel the most secure about, or that you um really appreciate the most about us going down this path? And she said it's the security. It's knowing that if the worst happens, we are covered, and we, she has a way out, a way for the future forward if it was me or vice versa. So I think it's so important. And it's one of those things that when you have that sort of security button down, you feel differently about how you approach things going forward. You at least know that if the worst happens, there's there's a clear, defined plan of what's going to take place next. It's not going to feel good. Like it doesn't replace the emotion, the loss, but it does add a sense of security that I think a lot of people are missing in their life. So yeah, I really appreciate what the way that you lay that out, Jesse, as well. I think it's a good way to think about it. And when I also think about coverage and how the typical person thinks about coverage, it's, oh, well, this number sounds good, or this number seems like it would make me feel secure. Well, but how do you know that? And I think it's asking those questions to ourselves first and foremost, but then that our job as practitioners is to really kind of challenge the thinking and rethink our thinking about these. What do we want it to look like? Do I want to have, my spouse to go to work within a certain amount of time? Or do I want them to never have to worry about it? Like these are all things that can come into place. But to your point, David, those are conversations that the husband and wife really need to have together and need to figure that out. What do they want that to look like? What do they want for the other person? And what are they most comfortable with? And then let's devise a plan that allows that to take place, or makes that happen for them. Obviously, that's more so on the protection side, but then you layer in the banking side of it, and now you have a whole different conversation about how it actually builds and helps the family as well. So
Yeah, I did an interview with my wife, and she as well said that the security aspect from the start was a big win for her. And I talk about this idea of a two-pronged approach very typically with my clients, that when we're looking at building a whole life policy for the purpose of implementing infinite banking, I still typically couple that with making folks aware of convertible term and how you can strategically use convertible term in conjunction with a whole life policy to begin banking right away. Your very first year, doing infinite banking, owning a whole life policy, utilizing a whole life policy, you're on the racetrack, right? Doing whatever it is that you're going to be doing with that policy, saving up an emergency fund, building capital for business purposes because you're a business, like whatever you're doing there. But then very, very typically, I couple, a proposal with, well, here's where you're at. Here's that matrix, right, David? You've got 7% acquired. This whole life policy bumps you up to 20% or whatever, but there's still 80% on the table. How much more of that would you like to acquire today? And I say that to them now. I didn't always do that. I didn't always suggest a typical approach of, well, let's look at the whole life policy. And then let's look at a convertible term policy as well, just so you're aware. Maybe you'll get that now, maybe you won't. Maybe you'll pick whatever number, like you were saying, Rob. $1 million sounds good to a lot of people just because it's $1 million, but is that appropriate? So we talk about that. But I didn't always do that. And, just being an open book, it was this year when I did turn 40. And when me and my wife were expecting our fourth child, that I had a moment of awareness as well. It's like, oh, I should probably do more myself. And I got another policy. I got a convertible term policy where I acquired actually however much the insurance company was going to let me have. Like as of the time of the application, when I got that policy earlier this year, they wouldn't let me have more than I got. But again, I'd already even been implementing the concept for 10 years before I knew that that was something, or just had a moment of clarity to say, oh, I should take myself to the next level even, right? Like I'm always thinking about the next whole life policy, so we could do more banking. I mean, I've got a new baby now. Right now, I'm actually like, well, we need to hurry up and get this birth certificate. We need to get all these numbers so we can submit an application to get a policy on this baby, right? But I actually maxed out my insurability this year as well. So I think protection is super important. Y'all just keep adding to my list. Does anybody have anything burning you want to say? I'll run some notes that I've written
I
down.
think kind of
Otherwise,
going back towards the beginning, what kind of changes hitting 40, I think a couple things happen. We're older. What we thought was enough money when we were in our 20s and 30s, $1 million seemed like a lot. The SGLI for the service members group life insurance that military is provided, of was 400,000 for a long time. Now they finally, I think, bumped it up to 500. Like that seemed like that was a lot and was enough. We've been through multiple business cycles. We start seeing the real effects of inflation over longer periods of time. We're like, oh, $1 million is nothing. By the time I'm about to retire, $1 million is going to be the equivalent of probably $200,000 at that point. The dollar's lost so much value and continues to lose it at an accelerating rate. Kind of the other thing that I think hits us when we hit our 40s is our invincibility, our mortality. The death benefit protection becomes more of a concern for us, um, with all of the other things we've been talking about, the providing for our family, and we have all these bills and line items stacking up, and it looks like there's a income problem. I don't have enough income to pay for all of these individual line items. That's because we're trying to do a whole bunch of separate individual things instead of doing one thing that meets all of the requirements by streamlining our the way we manage our money.
Being more efficient with our dollars. That's actually, you said something earlier that made me think, okay, that's what I'm getting from what Will is saying is same dollars, same cash flow, but being more efficient with it means that we get to check more boxes with the same literal dollars. So good. One more thing, at least that I'll say on the protection side of things, and why I'm such a big supporter of whole life insurance is last week had a conversation with a fella who's in this age category that we're talking about, okay? 40s, late 40s, beginning to take care of mother-in-law, becoming more aware of her financial standing because her husband has passed, being more helpful with that generation that's ahead of us, right? And finds out she's got a policy, wants me to look at that policy, wants to talk through, options. And hey, mother-in-law's got a whole life policy. She's maybe even talking about a policy loan. Yeah, send it to me. I'll look at it. And I get it. It's not a whole life policy. It's a universal policy. And I go on the page and I got to mark that page up and say, hey, buddy, I'm just reading the English to you right here. Here's where it says universal. Actually, it didn't so very boldly. It was abbreviated, but anyway, on the statement, on the annual statement. But it had a negative cash value. That policy had eaten itself. Yes, if she continued to pay a premium, the death benefit was still showing as the same. Death benefit still gets to be shown as, yes, this is in force, right? And the premium's not even changed. Hey, it's not costing you any more to keep this policy. But what's happening to the value that had been built? What's being consumed? Like the cost shows up somewhere. If it's not going to show up in a change in death benefit by lowering the death benefit, and if it's not going to show up in a rising premium, because the insurance company doesn't want to show somebody in their 70s and 80s a rising, if they can avoid it. So where does it show up? Well, it shows up in the value of the contract being a negative number. I can't lean in enough right here. A negative number. And that's a horrible thing to have to tell to somebody who's trying to care for an 80-something-year-old. That's a horrible thing. So I can't say enough about the value of a guaranteed level premium, a guaranteed death benefit, and if you're using mutual life insurance companies, the guarantee that if that company experiences a positive year, which all the companies that I own policies with personally have had positive financial years for over 100 consecutive years, we have a guarantee that they will share that dividend with us as well. So we can be having growing death benefits, growing cash values. And we're not even talking about infinite banking yet. We're not even talking about how the use of a policy, using our cash flows to build a private family banking system, can grow those numbers as well, because that happens as well. But just if you had whole life insurance and you put it on a shelf, I'm not saying you should, but boy, oh boy, is it better than having a negative value of a contract pop up in your 80s.
I have one thing to add, one thing that Will mentioned, and then one thing, Jesse, that you mentioned earlier. One is this idea that, you know, $1 million or whatever that number is, um, what's the future value of what you have in savings or even what you have in death benefit? So what I find magical about whole life insurance is that you're actually locking in uh, those dollars in today's dollars that you're going to be able to actually live with for the rest of your life because the premiums don't change. So you're actually locking in today's value of the dollar, irrespective of what happens going forward. That dollar is going to maintain its value over the course of time. That's one thing I think is important for people to understand. Secondly, Jesse, as you were talking about this idea about, retirement assets and actually, Rob, you mentioning about the average um, value of retirement assets, people, median between the ages of 40, 45 and 55, I think as you said was 115,000, but maybe my number's off a little bit. Is that what we would like to, as practitioners, educate people in the idea that you can avail yourself of what is the magic of compound interest of putting money, forced savings into a 401k or an IRA. We're just changing the way that you're creating this magic of compound interest and returns, but we're just doing it in a much more effective vehicle that's going to be a growth of value in if you compare the two between a 401k or money that you put away that's tax advantaged, you'll find, and we could show this to you, that the numbers that you grow of that asset's going to be much more powerful and will never stop. And Jesse, I know that you intentionally, when you've been speaking up until now, you used the word guarantee. That's a very important concept that I think that our viewers need to understand is that we're not dealing with um, vehicles that are relying upon potential returns going forward. We, as practitioners, we fall back to the guaranteed side because at the end of the day, don't we all want safety and guarantee. So I recognize, Jesse, as you were speaking, it's very important that it can't be emphasized enough in what we do and what we put in place.
Yeah, and I love how you talked about locking in the value of today's dollars. I would reiterate that part because when you do lock in the value of today's dollars, you're guaranteeing that they will create multiples within that whole life contract in the future. So good. All right, I'm talking so much that Rob's starting to raise his hand, so make sure that I notice him. I'm sorry, Rob. Talk to us.
No, that's quite all right. One of the things that I wanted to just touch base on really ties into what David was saying, and then a couple of or something that Will had said earlier. The first one is if somebody is kind of picking a number of what, and this could be their retirement, this could be their uh, life insurance, whatever it might be. If the number that makes you comfortable today, let's say it's, whatever, $1 million, $1.2 million, whatever, divide that number by 0.47. That's the factor you need to apply just to overcome inflation in the next 30 years. Because that's what it was from 1994 till today. It's 53% reduction in purchase power. So if you want that number to still feel comfortable, that's the amount of coverage, that's the amount of retirement that you need to target in the future.
And
And
that's
that
if you think,
assumes
sorry, I was
inflation
going to steal
stays
your
the
thunder.
same. No, go
Yeah,
ahead. You jump in, William. Go ahead.
I was going to steal your thunder. I apologize. You-
Is that what you were going to say?
yeah.
Yeah, that assumes inflation stays at the same rate. So it and it's a whole different conversation. Maybe in the next round table, probably with what you guys are digging into from
And
what I
that assumes you
understand, but
trust the government's inflation number.
correct.
Money's being
Correct.
created at 6% a year, but they'll tell us that inflation, the consumer price index, is only 3%.
Yep.
The math
And
doesn't
here's what
math there.
Yeah,
Sorry,
absolutely.
Will. Here's what I would encourage anybody, just in case there's somebody listening that hasn't ever done this, go to usdebtclock.org, usdebtclock.org, and just look at that for a minute, you can actually look at your state as well. It'll show you state by state and lots of other figures. But if you just looked at the national stuff, it's really, really mind-blowing. I'd actually written that down earlier when you were talking about inflation, Will. So I'm glad you're reiterating it, Rob. So good.
Just
Yeah.
watch the numbers climb for a second. Just don't just read the number. Watch it climb.
Yeah, there's a couple other things I wanted to just touch on that, and then we can kind of wrap up this section. One of the things was that, Will, I think you had mentioned it earlier, of a lot of, in place, if somebody wants to get started and just move the money from, a conventional savings account, whatever, and put it into a whole life policy, obviously designed the way that we would structure one. I think for a lot of people that can be a barrier. And the reason is the vast majority of people look at insurance as an expense, and they don't understand what whole life actually is, in that it is a contractually guaranteed asset. It is not just insurance. It has a lot of living benefits. It's more than just a quote unquote expense. So I think for any of our listeners or anybody that's watching this, there is a very key level of understanding that you have to break through first in order to really get what we're talking about here. And that first one is whole life is not just an expense. It's an accumulation of capital that you will have available to you again in the future. And not just in the future, potentially within 10 days after your policy is put into place. So that's a really important distinction that I think a lot of people need to understand, is it's not just about an expense. This is truly putting aside money that you can use that's going to be treated really well. So it's creating an environment for your money to be treated in a wonderful way, guaranteed, consistent annual compounding that doesn't stop. So the other item of that I think is important that ties right into those is that what we are talking about is not a this or that approach. We are not talking about you only do this or you only do that. This process is just about where you put your money first. So it's like our buddy Joe says, it's the before asset. When you put your money flowing into a system you own and control first, it is going to be treated better. And then you can still go do all these other things. If you still want to invest in the market, you can still go do that. No one is saying you can't. It's just it's giving your dollars multiple functions so that it can go work for you. Like Nelson says, it's money at work and people at work. That's really the only two ways you generate income. And this is how we help put money to work for us while we are continuing to work and still generate income. So those are the last things I had to say about it.
When I get to the point in my process where I'm doing a policy illustration walkthrough, Rob, I love, and like David said, I love going to the guaranteed side of that policy illustration. And again, I mean, I've got a episode on my encyclopedia series where I'm talking about policy illustrations. If somebody's listening, you haven't watched that video on me talking about the significance and insignificance of policy illustrations, I've got it in my encyclopedia series. I should put it in the notes. Check it out. But at some point, we're going to look at numbers, right? And I love going to that guaranteed side of the policy illustration and just walking my client through, hey, can you see with me, we're in the first year of owning this policy, that we could check off one or two of those 12-month goals that you have financially speaking right now? Do you see where it says that guaranteed cash value that we can leverage via policy loans to go out and pay off debts? Or maybe we won't leverage policy loans and we're just going to build capital here, and then that's going to be your emergency fund, your war chest. Do you see that number? Yeah, I see that number. Awesome. Well, let's go down 5 years, or whatever the number is. Do you see where at this point, after a few years of maturation, you're putting in this amount of premium and it's generating the same amount in cash value that you can leverage? And oh, by the way, your death benefits, grown as well. Do you see that here in just a few years? There's enough efficiency to where a dollar in is creating a new tax-free dollar that you can lever. Okay, yeah, I see that. Awesome. Well, all right, so let's go down here. And then we do go to say, some passive income, typical ages. We go to the 60s, we go to the 70s, and we look at the policy. And okay, do you see to where, and perhaps right here, there might be a drop in premium, right? Because an individual may only be paying base premiums at that point, because typically a paid up additions rider is going to taper off. Okay. But you're putting in this base premium, and can you see where in that guaranteed column, it's creating multiples? And I hesitate to even throw out a number right here, right? Because every contract is different. But do you see where a dollar goes in and two new dollars are created? Do you see where a dollar goes in and 5, 7, 17, right? Especially when you start looking at children's policies. I mean, if we start children's policies, like I said, me and my wife, we're ready to get this fourth baby policy in force today, but I got to wait, right? It can get really great. And again, that goes back to addressing inflation, like Will and all of y'all have brought up as well. If we could lock in that value, like David was saying now, especially on a child's policy, because us folks in our 40s and 50s and 60s, we're interested in still reaching down the family tree and being helpful to our children and our grandchildren if we have them. If we could be locking in that value of dollars, and then when they get to their 70s or thereabouts, they're creating, 17th, it's incredible, right? It's fantastic. So I like getting to that point in the process, and I've done that a couple of times recently here in the past, couple of days, even between getting home from the hospital with our baby. I love that. Y'all, I've got some notes. I'll tell you some things that still occur to me. And the number one, I want to leave people, because I feel like we've maybe spoken more to the folks that haven't implemented the concept yet. I could be wrong. Folks, y'all can let us know down in the comment section. What questions do you still have? What have we not touched on? I have some notes that I know we haven't touched on, but you let us know in the comment section. I'll get these guys to come back. The marching orders, the challenges that I would put to folks, regardless of whether you have or haven't yet implemented infinite banking, would be to go to that usdebtclock.org and just think big picture for a moment. Recognize the environment that we're all operating in, because our environment affects us. Okay. If inflation does increase, I think we should address that. Now, I think there's a lot more internally that we can do. And here's my challenge to everybody internally. I would encourage you and your spouse to sit down at the kitchen table, sit down at that dining table, and calculate your dollar amount of interest dollars that you're currently paying every month. All right. Pull up the mortgage, pull up your car notes, pull up everything. Okay. And I'm not talking about the rate. I'm saying if your mortgage payment is X, look up what percentage of that is interest. Write that down. Go to the cars, write that down. Go to everything that you're currently making monthly payments on and write that down. Now, if you tell me, Jesse, I pay cash for everything, okay, here's where I'm going to say, well, how much cash did you spend last month? Okay, and you know what your number is. I'm telling you to calculate that number. How much of that money do you still have today working for you? So see, I don't care if you're, dealing with bad debt or if you pay cash for everything. We're not keeping the money. Cash flows to us and away from us. All right. So my challenge is find out what that number is. If you paid cash for everything last month, how much cash? Is that cash still working for you? No, it's not. Could it still be working for you? Yes, it could. How much could that money turn into in the future? Who knows? We should talk about it. You should talk to Rob or David or Will. Okay. We should talk about that with you. But come to terms with what you are bleeding out financially to a dollar amount every month. That's my challenge. Does anything else occur to y'all to say, hey, yeah, Jesse, we should come back to this in a part two that sticks out to you, or any other strong suggestions that you have for people?
I think one thing that we could talk about in the future, and maybe even today, we'll see, is the actual implementation. So I'm 40, haven't done this yet. How do I do it? And I think Will had a great point earlier about if you have anything going into cash, today and it's just sitting there, that is a great starting point. Your emergency fund, your um, any cash savings that you have, that is a great place to start. And then working with a qualified practitioner who's going to be able to go through your system, ask you questions, really dig in. You might be able to find a lot more to help build that system more quickly. We can do that, but at a minimum, if you're tentative and you want to at least start, that is a great place to start. And it puts you down the path where you're now retaining more of that money that's flowing away from you. To your point that you just mentioned, Jesse, where people are calculating the interest, if anybody wants to have an idea of what cash is worth, I have run these numbers before, but $10,000 if you had 5% uninterrupted compounding over a 35-year time frame, it's about $46,000 in interest that you give up. So every time you pay $10,000 in cash and you want to figure out what you might have lost, even just using a 5% rate of return over 35 years, it's about 46,000 that you gave up in interest.
And then I don't know what the number would be after that, though, Rob, but the number not mentioned there would be the ghost number of what amount of death benefit could that capital have also created to go along with the real usable value. So I love that you pointed that out and did the math for us. Thank you.
Well, I'm a numbers person, so it helps bring it to life. So, but go ahead, Will.
Answering Jesse's question, I'd kind of go back to even, I think it was last month, and you did kind of a men's only one. This one ended up being men's only also, but that one was deliberate men's only. I see in the back there, Rob's got a book, a family's handbook. I want to ask you more about that in another time, but you just had a new baby. We've been talking about being in the 40s, thinking multi-generationally, being concerned about the legacy, pulling that thread more. I like the way you said it, of reaching down the family tree. So I see a lot of threads we could pull there for the listeners.
Yeah, I love that. I think that's great.
So I'm hearing that we could do a part two. I'm down for it. I still have some things that I think we should get to. People will let us know in the comment section as well. I think meeting people where they're at, Rob, is so important. Here's what I wrote down when you were talking last. Meet people where they're at. And it made me reflect on my own journey. When I saw infinite banking, I saw a way to get out of debt and a way to build financial independence. Those were probably the big picture, still kind of nebulous frames that I had for what this was going to mean in my life. Okay, I see a real pragmatic way to get out of debt, pay off the family car, pay off the student loans, pay off the credit cards, and we did that. But also, this is a route to financial control, financial autonomy. It's going to be that in the long run moving forward as well. Beautiful. That's what got me started. 8 months down the road, we got our second policy. It was real. We were making policy loans. We were paying policy premiums. We were paying off things. Time to get another policy. Why? Well, for a couple of reasons. I had a policy on me from that first one. We wanted more protection, having children, right? So we got the other adult, the other spouse with some protection, but also we were ready to put more capital to work to continue this process. And it still took me 3 years before I got a third policy. It took me another year after that. So maybe 4 years before we did even get policies on our children. So I'm just trying to be an open book, and you don't have to follow my time frame. You might do it faster. You might do it slower. Everybody's got an individual case. I'm just trying to be open about my trajectory and saying, I'm glad that somebody met me where I was at the time, but I am here where I'm at now, where I have said, I did turn 40. I did have a fourth child. I did just this year decide to get the maximum insurability on myself. So it's been a trajectory, right? It's like as you continue along this process, like Zig Ziglar would say, go as far as you can go. And when you get there, you'll be able to see further because you've gone further down the road, right? So like that's just me, showing up here with y'all, fielding this conversation. trying to implement this concept at a higher level, always myself personally, but also help other people do the exact same thing. And I know that we're all here to meet everybody where they're at. So again, David, did you have any other final thoughts, suggestions for people? I don't want to skip you.
It's all right. Thank you for having me today. What I would love to discuss in the future, and you brought it up, and it's actually staring me in the face as we're on this webinar, is this idea of like um, how the systems that we're building for people are protecting them from the financial system that's been created, um, that they don't have. They currently, if they're not using IBC, in my professional opinion, they're now a victim of a system that they're not controlling. And when you look at, let's say, things like the US debt clock, where the US federal debt to GDP, that ratio is over 100%. There's going to be the roosts are going to come to roost at some point. Where we keep kicking this proverbial can down the road. And again, I would love to explore in future conversations the economic basis for what IBC is grounded on, which is Austrian economics, and how that can be brought down and be where we can educate our fine viewers about what the basis for a lot of what infinite banking is, which is the idea of having your money basically be a real asset that you control, rather than your money being in someone else's control, and how economics plays a very strong part, and how inflation can also be, and all of these other various economic um, philosophies and tactics, how they dovetail into what we do as IBC practitioners.
I love it. Rob wants to talk more about implementation. David wants to talk about financial environment. Will wants to go further into reaching down into the family tree and implementing the concept with them. It sounds like we need a part two to me. I have some notes here that I haven't got to, but I think we'll address it also, David, when we maybe go further out in the time frame, talk about infinite banking in your 50s, 60s. I like your suggestion. I think we're going to do that. So my suggestion, of course, again, to everybody is that to hear more from these guys, their own personal origin story with the infinite banking concept, go check that out in our interview series. I can put links in the comments below here, as well as any of the other videos that I have referenced. Their contact information will also be in the show notes. If you find these videos helpful along your infinite banking journey, make sure to subscribe to the channel. Live and leave a lasting legacy.